Good morning. I'm Tim Nyland, and today we are wrapping up our Lost Decade in Stocks series with our third and final webinar on the topic. Be sure to stay tuned throughout the entire webinar. You're going to be shocked at what we uncover as we take a closer look at S&P 500 sector level and earnings certain portfolio valuations during the Lost Decade. Towards the end, I'm going to show you how to create portfolios that will thrive should we find ourselves working through another Lost Decade in stocks. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you're going to need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Today's webinar, again, is part 3. I've got the prior 2 webinars circled in red. They can be found on our channel. Before we get started, I wanted to invite all of you to take a look at the Zacks Mutual Fund Rank. The Mutual Fund Rank utilizes factors shown in academic research to predict future fund performance. Within each Morningstar fund category, we believe that Zacks Rank number 1 funds will outperform Zacks Rank number 5 funds. As a matter of fact, your chance of selecting a fund that outperforms the category average will increase by over 20% if that selection was made from a Zacks Rank 1 fund versus a Zacks Rank 5 fund. The return spreads between the portfolio of Zacks Rank 1 funds versus Zacks Rank 5 funds in most categories range from roughly 1 to 2% or even more. So for anyone acting in a fiduciary capacity, this is exceptional and is a must-have component for your investment process. Just click the link in the description below this video and you'll get a free copy of our Zacks Mutual Fund Rank Guide. Let's go ahead and get started. So if you only learned 2 things from the Lost Decade series of webinars, I want it to be these 2 things. Trying to interpret a PE ratio without the historical context of equity risk premium will result in inaccurate conclusions. We spent quite a bit of time discussing the ramifications of that in the prior 2 webinars. We're going to take a look at some real life examples here in just a minute. And point number 2 is that your equity portfolio can still appreciate in terms of total return, price return, as long as it has strong, consistent EPS growth, despite long-term PE multiple contraction driven by long-term rise in equity risk premium. And that's going to be the focal point of today's webinar. So let's go through just a couple of quick examples. I think this will be very, very helpful to everyone just based on several questions that I received over the past week or 2. So a client says to you, hey, I've heard that the 20-year average S&P 500 PE ratio ranges roughly between 15 and 16 times. The market sure seems expensive now with the S&P 500 PE ratio sitting well above 21x. And my response to that would be that the current levels of the S&P 500 PE ratios are justified trading at the higher end of their 20-year range because that equity risk premium is at 20-year lows. And you can then further cite that if equity risk premium were to trend back to the 20-year median, then the S&P 500 PE ratio would also trend back to its 20-year median, which is the 15 to 16 times range. And you can actually see on the slide where I illustrate that. So all-time highs here for the S&P 500 PE, 20-year lows for equity risk premium. You can see that really strong inverse correlation here. And as a matter of fact, if you walk the PE ratio line back to the last time we actually touched the 20-year median, as a matter of fact, it was at the same time equity risk premium was also at its 20-year median. So this move that we've had in the S&P 500 PE, much of it can be attributed to the fact that equity risk premium is sitting at 20-year lows. So that would be the proper response. And sample 2, and this is a sample really coming out of last week's webinar. I wanted to give a real life sample just to kind of wrap up everything that we did last week. I personally utilized the Zacks valuation model to challenge pretty much all of the research that I read. And so this is a really, really good way in default mode. The valuation model allows you to more or less challenge the sell side research, at least the analysts that contribute to Zacks. So you could literally plug in any assumptions that you're reading into this valuation model and it will output a warranted PE. So if you're doing this and you're reading a research report from a highly respected Wall Street firm that says Verizon should be trading at a PE ratio of roughly 14 to 15 times, and we see here that its actual PE is about a 10.5. Is it undervalued? And the question here is, what do you think? And the response here, if you do the equity risk premium analysis, right? So Verizon in its current business model happens to be a flight to safety name. And today's macro environment has resulted in equity risk premium trend down to 20-year lows over the past 8 years. So the likelihood of Verizon being valued at a PE of 14 to 15 times at current levels of equity risk premium, remember, over the past 8 years, this has been a completely risk-off environment as equity risk premium has just been continued driven down, down, down. The last time Verizon traded at a 14 to 15 times PE ratio was in 2011, 2013, where equity risk premium was greater than 5.62. So we would really need to see equity risk premium rise. We would really need to get that. I apologize. Over the last year, this has been a risk-on trade with equity risk premium being driven down. We would need to see a risk-off trade, equity risk premium rise for Verizon to warrant a PE ratio of 14 to 15x. So I apologize for that confusion. But at any rate, you can see how valuable it is to understand the actual levels of equity risk premium relative to its history. So let's continue on. So let's go ahead and start going through the S&P 500 sectors so that you guys can get a really, really good understanding of what happened at the sector level. And what I'm going to do here, the intent is to paint a pretty grim picture, right? Because the lost decade in stocks was a very frustrating time period, those that lived through it. And I want everyone to see kind of the magnitude of this PE multiple contraction across the bulk of the sectors. So let's start with the base scenario. Again, this is the format of charts that we'll use to just quickly bump through all of the 11 sectors in the S&P 500. And what I want everyone to understand here is, again, that really strong correlation. Recall from the interactive chart and the regression that we ran in prior webinars that equity risk premium is able to explain roughly 73% of the movement in the S&P 500 PEF12M. So keep in mind that back here, this is again a 20-year chart. Back here in 2000 to 2002, the PE actually peaked at around 25. I'm using a 20-year chart here, so we just call it 22. That PE multiple of 22 to a collapse of 13, we're going to basically dissect that at the sector level. And again, that equity risk premium, that macro factor, ended up rising from 3% to 8% in the lost decade, and that's that risk-off trend. So as that risk-off trade takes hold, equity risk premium continues to rise. Okay, and you can see that when we look at PE F12M on a relative basis relative to itself, it's a 1. So now we're going to move into each of the sectors, and you'll see that I've got a PE F12M on the top. I'm going to keep equity risk premium here in the middle just so you can see the magnitude of that risk-off trade. And then what I want everyone to pay attention to is the top panel and the bottom panel. So we're looking at the actual movement of the PE multiple for the sector in the top panel, and then we look at it relative to the S&P 500 in the bottom panel. And the idea here is to not overcomplicate this. We're looking at basic trends. We know that the S&P 500 PE multiple collapsed, right, from a 25 to 22x all the way down to a 13x by the end of 2012. So the idea is, on a relative basis, if this red line is sloping up, then we know that that sector ended up faring better than the S&P 500. If it's sloping down, we know that it got punished more than the S&P 500. Okay, so we're going to make this really simple. I've actually gone through and pulled the start points of the series, and I've actually pulled the 12/31/2012 point, and I've actually got them on the screen. So please request a copy of the slide deck so that you can review this at your leisure. And a lot of this information obviously will be very valuable to you in the future. So when we look at the consumer discretionary sector, you'll see that the PEF12M relative to the S&P 500 started here at basically 0.92. So all the way back here at 0.92, and it rose to a 1.28. And the way I want you to think about that is what that means, if you subtract this from 1, it means that the consumer discretionary sector back at the start of the lost decade was actually trading at a discount of 8%. So 1 minus 0.92 is 8% discount on a PEF 12M basis relative to the SP 500. By the time we ended up exiting the lost decade, it was trading at a premium of 28%. So as we had that risk off trade move through the lost decade, the consumer discretionary sector actually benefited, right? Because we ended up moving from a discount of 8% on a forward multiple to a premium of 28%. So fund flows obviously moved in that direction. When we look at staples here, you can see another downward slope for the PE multiple itself and consumer staples over that lost decade. But as a matter of fact, we actually traded at a premium, right? So that PE multiple contraction was not, in fact, as severe as the S&P 500. So we actually went from parity at the beginning of the lost decade. So this point here is actually trading at parity to the S&P 500 to a premium of 16%. So 1 to a 1.16. Okay. Energy. We had some earnings troughs out here beyond 2015, so I actually had to trim it to keep the scalings to look proper. And you can see that PEF 12M relative to the SP 500 went from a 0.72 to a 0.84. So at the beginning of the lost decade, energy was actually trading at a 28% discount relative to the S&P 500, and we moved to only a 16% discount. Okay. So financials, 0.75 to 0.81, we actually went from a discount of 25% relative to the S&P 500 to a discount of 19%. And again, that's from beginning to the end of the lost decade. Okay. Healthcare got crushed. PEF 12M relative to the S&P 500, 1.25. We started out at 25% premium, ended up at only a 1% premium. So here's a PE collapse that was actually more severe than the S&P 500. Industrials, we traded at the start at a 5% discount, and then we moved to parity. So not a whole lot changed for the industrial complex. The real decimation occurred in information technology, right? PEF 12M relative to the S&P 500, 1.61 down to a 0.93. So at the beginning of the lost decade, and keep in mind, we're coming off the dot-com boom, we were at a premium of 61% relative to the S&P 500. By the time we ended the lost decade, we were at a discount of 7%. That is a massive swing, and you can see that multiple collapse here. And you can see that we've regained some of that footing as we've moved through the next decade. Okay, we move on to materials. Again, just like industrials, not a whole lot changed, right? Beginning of the lost decade, we were at a 7% discount. And by the time we ended the lost decade, we were only at a 3% discount. So not a huge change. Telecommunications Services was actually a winner. We started at a 16% premium and we ended up at a 26% premium, even though that PE multiple did contract. Okay, so again, the lost decade, it really hit most all sectors, but some sectors ended up faring better than others relative to the broader S&P, obviously. And telecommunication services is one of them. Real estate was your big winner. PEF 12M relative to the S&P 500, we started out at a 32% discount and then ended up moving to a 62% premium, right? Now we know we don't hold real estate in course. This is going to be an important one to consider tilting to the extent we get into this type of a scenario. Okay. Same thing with utilities, although utilities are a little bit different story now because as equity risk premium has gone down in the subsequent decade, post lost decade, that PE multiple has continued to expand. So this is exactly opposite of what we would expect from utilities. And a lot of that was obviously Fed driven with low interest rates and the utility sector competing for yield there. So we've got to be careful here in the utility space. The fact that that this would repeat, I'm not so sure about that. We went from a discount of 41% relative to the S&P 500 to a premium of 10%. So obviously a huge winner during the lost decade. We saw that the utility space got absolutely hammered during COVID, which is something that I had been calling for quite some time. Very, very overvalued relative to growth. And the reason for that is obviously investors just continued to bid that PE ratio up and up and up, even though equity risk premium was on the decline. And we all know that that the utility sector itself is not a risk-on trade. And clearly, when equity risk premium is on the decline like this, that is very much a risk-on environment. Okay. So let's take a look at how the earnings certain family of equity model portfolios performed during the lost decade. When I'm talking about performance here in this context, again, I'm talking about those same relative valuations. And again, my idea here that I'm trying to paint is kind of a grim picture. I want everyone to see that there's really not a safe area in terms of this PE multiple collapse. In other words, when that equity risk premium is on the rise, even the earnings certain family of equity model portfolios, even the 75 stock core experienced a PE multiple compression. Okay. However, you can see that in the bottom panel, the upward slope, it was not as bad as the S&P 500. So we went from a premium of 13% to a premium of 22%. So the earnings certain core 75 stock portfolio actually fared a little bit better in terms of relative PE than the S&P. You can see a similar scenario here with the Admiral, right? So the Admiral PE multiple compression, just like the core 75 stock, just like the S&P, but not as bad. We went from a premium of 17% relative to the S&P 500 to a premium of 18%. So still a little improvement over the S&P. When we talk about the earnings certain core dividend 25 stock portfolio, we went from a premium of 25% relative to the S&P to a premium of 20%. So almost flat, a little bit of a decline, nothing really material. When we take a look at the earnings certain 6 stock macro tilt, this is probably the one that everybody's wondering about. Again, what we find here is that we went from a premium of 112% relative to the S&P 500 to a premium of 102%. So a little bit of a decline. Obviously, that PE multiple compressed as well, coming off the back of the dot-com bust, as we would expect, all the way through 2012. And you can see what's happened, obviously, since then. Okay. So again, I was trying to paint kind of a grim picture. So at this point, hopefully you're thinking to yourself, wow, this looks bad all around. And this is something that I had alluded to during last week's call, is that if you're building your portfolios where you're focusing more on EPS growth and outpacing that PE multiple contraction that would result from a rising equity risk premium, you're going to be in a lot better shape. So let's recall the statement that we wrapped up with at the end of last week's webinar. I put it in quotes here. You can find it on the very last summary slide page of last week's deck. And it's that long-term tug of war between EPS growth rates versus rising equity risk premium that can lead us to another lost decade in stocks. And this is obviously going to be marked by that slow PEF12M contraction over time, very painful. However, properly constructed portfolios with strong, consistent underlying earnings growth can still appreciate despite that PE multiple contraction. Again, think about it. You've got a PE multiple. We're expressing price as a multiple of earnings. So if your earnings growth is outpacing the contraction in PE, you'll still end up with appreciation. And that's what we're going to show right now. So to do that, what I'm going to do is I'm going to look at the Zacks research system adjusted earnings. We call that the before non-recurring items number. And what we're going to do is we're going to look at the growth rates of earnings from 2000 to 2012. And you can see that the earnings certain core 75 stock portfolio was able to grow earnings literally at 371%. And the S&P 500 grew earnings at about 147%. And you can see that it took investors for several pretty turbulent rides with some significant earnings troughs. So that red line being the S&P 500 composite growth versus the earnings certain portfolio, which we know is going to be much more stable and much more arrow straight. Okay. This is significant because even though the PE multiple is compressing, you're growing earnings here at more than twice the rate of the S&P 500. So even though the PE multiple is compressing, that price to earnings bid, if you're growing your underlying earnings at a 2 times faster rate than the S&P 500, obviously you can expect that portfolio to continue to appreciate in value, unlike the S&P 500 that obviously stayed flat for that entire lost decade. So let's take a look at how the earnings certain core Admiral 30 stock portfolio fared. And you can see that was 417% again compared to that S&P 500 of only 147%. You can see what that looks like. Obviously, the Admiral 30 even more defensive. The line is even straighter, ripping through even the Great Recession earnings trajectory, virtually unscathed. Not so much for the S&P 500, and that's the real problem. The core dividend 25 stock portfolio, 231%. We would expect that growth to be tapered a little bit, right? That's a reasonable expectation because we've got a higher payout ratio. You reinvest less into the company, you're not going to grow as fast, and that's completely reasonable. You're still getting probably 50% or better earnings growth relative to the S&P 500, even with a dividend strategy. So that looks really nice. Here's the shocker of all shockers, and I actually had to move the base date forward 1 year because earnings were so low for the composite as a whole that I had a base effect going on, and the earnings growth was actually in excess of 25,000, and it was a little bit distorting. So I moved the base date forward 1 year to taper that growth. We're not necessarily interested in the absolute numbers. I'm just trying to show trend here, and obviously this does a really good job because the 6 stocks that represent the macro tilts, they were up 5,331% earnings growth versus the S&P 500 at 147%. Okay. Now, what I want everybody to notice here is this tapering, and it obviously caught my attention here at 2012. And I said, wouldn't it be interesting to take a look at what it's done from 2012 to current? So that's what I've done. So let me back up here. You can see this growth taper a little bit here. So the very next slide, we take a look at this basically from 2012 to current. And this will obviously include Facebook at this point, right? Because Facebook went public in 2012. And you can see that that the tilt earnings growth here struggled just a little bit. And then obviously since 2015, it's really just been moving up quite nicely to the point where from 2012, we've got about 665% growth versus the S&P 500 at 127% growth. So again, as we're going through these slides, I want you to think about the components of a PE ratio. Even if you're getting a multiple contraction, right? If you're growing the denominator by this amount and it's a multiple, right? The valuation on price, you're still going to end up with price appreciation because of the fact that you're growing the earnings at that much of a rate. So let's take a look at how this actually translates into price performance. And again, recall that I'm using composites out of the Zacks research system. So this is going to be the composite average price performance of each of these portfolios. So I'm not using the S&P 500 index. I'm actually using the market-weighted composite so that we have an apples-to-apples comparison of how the average stock ended up performing in each of these groups. And it's very, very indicative of index performance, but it's not going to be a one-to-one. But you'll get the general idea here. Earnings certain core 75 stock portfolio increased 174%. And we would expect that off the back of 400% earnings growth relative to earnings growth for the S&P 500 that was only roughly 100 and I can't remember what it was in the mid 100%. S&P 500 5%, 5.7%, so almost zero. Again, I think I picked 8/31 of, I can't remember what I picked, 2000 I think is the start date. So yeah, it's right up here in the title. So 8/31/2000 is the start date, and ran it through the 12/31/2012 point. So that's the earnings certain core 75 stock portfolio. When we take a look at the earnings certain core Admiral 30 stock portfolio, again 154% price appreciation relative to the S&P at 5.7%. And again, we would expect that outperformance because the earnings have just outperformed the S&P 500 by that amount. It's just been massive. And we had a little bit of a slowdown in earnings growth here relative to its other earnings certain core portfolio members. So the 75 versus the Admiral, obviously more growth oriented than the core dividend. So you would expect this price appreciation to be just a touch less. As a matter of fact, it is. It's 79%, but that's still a whole lot better than the S&P clocking in at 5.7. Okay. Here's the shocker: the earnings certain 6-stock tilt portfolio increasing 333% over that time period, even though we experienced a PE multiple contraction, right? That was consistent with the lost decade. Why? How is that possible? Well, again, when you're growing earnings at 5,000% over that time frame, even if the multiple contracts, you've outpaced that contraction with earnings growth. And that's the real takeaway of this webinar today, again, versus that S&P 500 at 5.7%. So what did we learn throughout this 3-part series of the lost decade? That the lost decade was real, and many of you may not have been aware of it, actually. For those that were, you recall that it was a time of great frustration and misunderstanding of the real cause. So now you are all armed with the real cause, the 6 warning signs of another lost decade in stocks, and what it takes to construct a portfolio that will withstand a decade-long rise in equity risk premium, right? We've really got to favor that consistent, solid growth. We've also learned that trying to interpret a PE ratio without the historical context of equity risk premium will result in inaccurate conclusions, and that's at best. The solution that I have for you is to use relative valuations to neutralize the effect of equity risk premium on PE multiples. So if you don't have access to the research system, just be sure that you're always backstopping any assumptions that you're making on valuations by doing it relative to something else. It doesn't even have to be relative to the S&P 500. If you're looking at Coca-Cola, just look at the PE ratio of Coca-Cola relative to Pepsi. At least you'll be taking out the equity risk premium component of that PE ratio. That's the whole idea behind relative analysis. Most people don't even know why they're doing it, but that's the reason why you're doing it, because there is an equity risk premium component for both Coca-Cola and Pepsi. When you've got one in the numerator, one in the denominator, the impact of equity risk premium divides itself out, it cancels. So you neutralize the effect of equity risk premium on PE multiples by simply making it relative. So if you're looking at Coca-Cola, make it relative to the beverage industry, make it relative to Pepsi, make it relative to the S&P 500, make it relative to something before you just assume that current valuations are less or more than valuations 10 years ago. Okay, at least you'll accommodate that equity risk premium portion. The third thing that we've learned throughout this 3-part series is that your equity portfolio can still appreciate with strong, consistent EPS growth. And that's despite that long-term PE multiple contraction driven by long-term rise in equity risk premium. So again, the underlying companies in your equity portfolio, we need to make sure they have consistent and strong earnings growth to combat that contraction. Okay. So that's about it for this week. Thank you all for attending. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. And please feel free to email us, call us for a copy of this slide deck or any of our slide decks. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you for watching, and I'll talk to you all next week.